Hey everyone, welcome back to Corporate Decoder, the place where we crack open those dense corporate filings to find the juicy bits. Today we're looking at TherapeuticsMD, Incorporated's latest report, and boy, do they have some news that might make you sit up and take notice, especially if you are keeping an eye on their stock. Before we dive in, if you'd rather have a simple explanation of complex financial news like this, do us a favor and hit that subscribe button. And hey, we've got a fantastic community over on Discord, linked in the description below, where we break down more of these reports. Alright, let's get straight to it. This kind of report, an 8K, is like a company's way of saying something important just happened. It is not a routine update, it is for significant events. Think of it as an urgent bulletin from the corporate world. And for TherapeuticsMD, a company known for women's healthcare products. This bulletin is all about their financial results from the third quarter of 2025, the period ending the 30th of September. So what's the big announcement? TherapeuticsMD put out a press release on the 12th of November of 2025, sharing their financial performance for the first 9 months of the year, with a specific focus on the third quarter. This is where we get to the heart of how the company is actually doing, beyond just the headlines. This company's main stock trades on the Nasdaq under the ticker symbol TXMD. That is the primary way investors track its performance. And usually when a company releases its quarterly results, it's a crucial moment for investors to gauge the company's health, its growth, and its future prospects. Now, let's talk about the actual numbers. While this filing doesn't include a detailed financial statement directly, it references a press release, Exhibit 99.1, that contains the key financial figures based on typical reporting structures. We'd expect to see details on revenue, expenses, and profitability for TherapeuticsMD, which operates in the pharmaceutical and healthcare sector. Their revenue would likely come from sales of their prescription products. Investors will be looking at whether those sales are growing, shrinking, or staying flat. Crucially, they'll also be looking at profitability. Are they making money or are they losing money? In the pharmaceutical world, it is not uncommon for companies, especially those developing new treatments or expanding their market share, to have periods of losses. However, sustained losses can be a major red flag. We'd want to see if their revenue is growing faster than their expenses to move towards profitability. A steady increase in revenue is good, but if costs are rising even faster, the company might be burning through cash. Companies often report something called adjusted EBITDA, which stands for earnings before interest, taxes, depreciation, and amortization. This is a way to look at a company's operating performance without the impact of financing decisions, accounting choices, or market conditions. It is meant to give a clearer picture of the core business's ability to generate profit, but it is important to remember it is a non-GAAP, generally accepted accounting principles measure, so it is not always directly comparable across different companies. We'd want to see if this adjusted figure is improving, showing that the underlying business operations are becoming more efficient or profitable. In the healthcare sector, research and development, or R&D, is a huge part of the business. Companies pour money into discovering and testing new drugs and therapies. While this is essential for future growth, high R&D spending can significantly impact current profitability. Investors will be watching to see if this spending is leading to a promising pipeline of new products. If R&D costs are high but there are no new products on the horizon, it could be a sign of trouble. On the balance sheet side, we'd look at their total assets. This is everything the company owns. A growing asset base can be a positive sign indicating expansion or investment. However, it is also important to see how those assets are being utilized. Are they generating sufficient revenue and profit? Then there are liabilities or everything the company owes. High levels of debt can be a risk, especially if interest rates are rising or if the company's cash flow is not strong enough to service the debt. We'd want to see a reasonable debt to equity ratio, meaning the company isn't overly reliant on borrowing money. Deferred revenue is also interesting. This is money a company has received for goods or services that haven't been delivered or performed yet. For a healthcare company, this could relate to certain contracts or product sales that extend into the future. A growing deferred revenue balance can sometimes signal future revenue streams. And of course, we review operating expenses. This category includes everything from the cost of goods sold to selling, general, and administrative expenses. Keeping these costs under control is vital for profitability. If operating expenses are increasing faster than revenue, that's a concern. Looking at the top line, net sales is always the first thing. For the third quarter, we'll want to know how much money they brought in from selling their products. Is this number moving in the right direction compared to the previous quarter and the same quarter last year? For instance, if net sales were up by, say, 10% from last year, that is generally a positive signal of market demand. But if they're down 5%, that means they're selling less, which could point to competitive pressure or weaker product demand. Then there is other income expense net. This captures all the financial activity that isn't directly related to the company's main business, like interest earned on investments or interest paid on loans. While usually smaller than the main revenue streams, significant fluctuations here can either boost or drag down the overall net income. And finally, the number of shares outstanding. This is important because it affects earnings per S-share or EPs. If a company issues more shares, the same amount of profit is divided among more owners, leading to a lower EPs. Conversely, if they buy back shares, EPs can increase. So, even if net income stays the same, the EPs can change based on share count. So, what is my take on TherapeuticsMD Incorporated based on this filing? Well, this is an 8K filing that points us to a press release about their third quarter financial results. Without seeing the actual numbers from that press release, it is hard to give a definitive analysis. However, the fact that they are reporting these results is a standard part of operating as a public company. For TherapeuticsMD, their performance will hinge on their ability to grow sales of their core products, manage their expenses effectively, and perhaps most importantly in the pharmaceutical industry, develop and launch new innovative treatments that meet unmet medical needs. The key risks for a company like this often involve regulatory hurdles, competition from larger players, and the long and expensive process of drug development. Now, to give you a more concrete opinion, we'd really need to dig into that Exhibit 99.1 mentioned in the filing. That is where the actual financial numbers will be. We would be looking to see if revenue is consistently growing, if their expenses are under control, and if they are moving towards profitability. For example, if they reported a significant increase in sales for a particular product, that would be a strong positive. On the flip side, if expenses like R&D or marketing are ballooning without a clear path to increased future sales, that would be a point of caution. Ultimately, the health of TherapeuticsMD Incorporated, like any pharmaceutical company, is a story of innovation, market penetration, and financial discipline. We'll be keeping an eye on their future filings to see if they can turn these results into sustained growth and profitability. Alright. That is our quick look at this TherapeuticsMD filing. What is your take on these kinds of reports and what signals you look for? Drop your thoughts in the comments below. If this breakdown was helpful, please give this video a thumbs up and don't forget to subscribe for more corporate deep dives, and hey, join our growing community on Discord. The link is in the description. Thanks for watching and we'll see you in the next one.